Welcome back to Talk Tickers. We are diving deep into one of the biggest names in the REIT space tonight, SPG Simon Property Group.
The heavyweight champ.
Absolutely. It is after hours, February 2nd, 2026. The market's closed, the conference call just wrapped up, and we've got the numbers.
And what a call it was.
Yeah.
You know, these things can be pretty dry, but David Simon, he always brings a little bit of heat.
He always does. So let's set the scene with the tape. The stock right now is trading down, about 1.2% after hours?
Yeah, pretty muted.
Very muted. And the options market was pricing in maybe a 2% move either way. So no fireworks expected and, no fireworks in the price.
Not in the price, no.
Yeah.
But the print itself was, let's call it noisy. If you're just scraping headlines, this thing looks chaotic.
Okay.
But if you actually dig in, this was an execution quarter. The internal machine at Simon is just, running hot.
So the street is kind of shrugging, maybe because of macro fears. We heard a lot about tariffs on the call.
Oh, we're definitely going to get to the tariffs. That was wild. But first, we have to clear up the scoreboard because there is one massive, very misleading number scaring everyone in the face.
You're talking about the GAAP EPS?
Oh, yeah.
So let's run it. GAAP earnings per share, a staggering $9.35 diluted. The consensus was looking for $3.47.
I mean, that's a beat of almost $6.
You'd think they discovered gold under one of their malls.
And this is where we have to, stop the tape right now. For anyone listening, do not trade on that number.
Right.
That $9.35 is it's pure accounting fiction. It has nothing to do with cash flow. It's all driven by a non-cash gain from the Taubman Realty Group buyout.
It's paper money.
It's paper money. It looks great, but it doesn't pay the dividend.
Okay, so let's get to the real numbers. In the REIT world, it's all about FFO, funds from operations. What did that look like?
See, this is where they crushed it. Real Estate FFO was $3.49 per share for the quarter. For the full year, $12.73. That's a clean, solid number. It shows the core business is working.
And the revenue backs that up. $1.79 billion, beating the $1.5 billion consensus. That's a big beat on the top line.
Which tells you people are in the malls and they can charge rent.
And for the income investors, they bumped the dividend up to $2.20 a share.
A 4.8% sequential increase. You don't do that if you're worried about next quarter. That is pure confidence.
So let's talk about the actual assets. The whole mall is dead narrative. I mean, it feels like we hear it every quarter, but the data here just doesn't support it.
The mall is dead. Thesis is dead. Look, occupancy for their U.S. malls and outlets finished the year at 96.4%.
Which is basically full.
It's effectively full. And when you're at 96%, you have pricing power. You saw it in the rent number. Base minimum rent is up to almost $61 a square foot, up 4.7%.
That's above inflation. That's what you want. And what about the consumer? Did they show up for the holidays or are they tapped out?
They showed up. Retailer sales were $799 a square foot. But the key metric, total sales volume, it grew 4% in the fourth quarter. People were spending.
So, quick summary. Business is healthy, the narrative is wrong, and this little dip in the stock is probably just some profit taking after it hit 52-week highs last month.
It's healthy digestion. But, the numbers are just the result, the strategy, the inputs. That's where the call got really interesting. They've talked about quarterizing.
Quarterize, yes. It sounds like a word from a corporate retreat, but they were talking about the Taubman acquisition.
It's a totally made-up word. David Simon even joked about it on the call. But the strategy behind it is very real. Remember, Taubman has some of the best luxury assets in the country.
International Plaza, Cherry Creek.
Exactly. And now Simon is taking over leasing and management of all of them.
And there was a weird detail there where adding these amazing assets actually made their occupancy stat go down slightly.
Right, by about 20 basis points. And a novice would see that and panic. But Simon's management, they look at that and see opportunity.
Because a vacant spot in a place like Cherry Creek isn't a problem.
It's an upgrade opportunity. If Taubman had a weak tenant, Simon is happy to see them go. They can bring in someone better, jack up the rent, and enhance the merchandise mix, as they put it.
Speaking of forcing situations, let's pivot to the Saks and Neiman Marcus deal. This was complex, but it was a masterclass in financial engineering.
This is vintage David Simon. It is all about leverage. So here's the setup. SPG had this investment in the Saks Neiman entity. On the call, the firm, they wrote it completely off, took the hit. It's a zero on their books.
Okay, so on paper, it's a loss.
If you stop there, yes. But In exchange for their cooperation in the deal, they got these massive concessions on the real estate side, just huge.
Like the lease termination rights?
Exactly. They now have the right to kick Saks out of 2 buildings if they miss a payment. No long court battles. Just you're out.
Which is huge. And then there was the REA control.
Right.
What is that exactly?
REA stands for Reciprocal Easement Agreement, and it is the bane of every mall developer's existence. It's basically the contract that gives the big anchor stores, the department stores, veto power over the rest of the mall. They can block you from redeveloping anything. They hold the land hostage.
And Simon got the right to redevelop those boxes without the tenant's approval.
That's the move.
Yeah.
It unlocks the value of the land completely. If Simon wants to tear down a Saks and build a hotel, Saks can't do a thing about it.
Wow. And the third piece was the IP ownership.
This is the kill shot. They got the right to convert their investment into actual ownership of the brand names Saks Neiman, which are managed by Authentic Brands Group.
So let's just put this all together. They write off the cash, but they get the right to evict the tenant, bulldoze the building, and own the brand name if the company fails.
It's brilliant. It's a protection racket, but it's legal. If the tenant lives, they pay rent. Great. If the tenant dies, Simon gets the real estate back clean, and they own the brand. They can't lose.
It's playing chess while everyone else is playing checkers. But yeah, speaking of tenants losing, they were surprisingly blunt about the macro picture, specifically tariffs.
Yeah, this was the sober part of the call. David Simon was not messing around. He drew a very clear line in the sand.
He said, and I'm quoting, "It's really Costco, Walmart, and Amazon, and then the rest of us."
The rest of us. He put his entire tenant base in that bucket. He said tariffs are taking hundreds of millions of dollars of economic value added away from these retailers.
And that squeezes them. The big guys can eat that cost. The smaller specialty shops at the mall, they can't.
They can't. And that's the risk for 2026. And the anxiety around this was so real that we had what I'm calling the polymarket moment.
This was my favorite part of the call. I couldn't believe it.
It was absolutely wild. During the Q&A with analysts, David Simon turns to his IR guy, Tom Ward, and literally asks him to check the betting odds on polymarket.
Live on the call.
Live on the mic. For the Supreme Court ruling on the tariffs, he wanted to know the odds.
What were they?
Tom came back and said it was something like 25 to 32% that the policy would survive. And Simon's reaction was basically, okay, that's going to be an interesting opinion if it does.
It just shows you how much this is on their mind. They're watching gambling odds on court cases because it impacts their tenants' ability to pay rent.
And that caution, that uncertainty, is probably why the 2026 guidance felt a little, conservative.
It felt very sandbagged. So they're guiding FFO to 13 to 13.25 per share and NOI growth of 2 to 3%.
Which feels low. And they admitted, look, we set this budget in mid-December. Since then, some more retailers have gone bankrupt. But, and this is the important part, they didn't lower the guidance.
Which means they have enough buffer built in, they can absorb the bad news.
Exactly. The leasing pipeline is up 15% year over year.
Yeah.
30% of that is new deals, not just renewals. The demand is there to beat this guidance if the consumer just hangs in there.
So the growth in 26, it's not from buying more stuff, it's from fixing what they have.
It's an asset reinvention story. They're expecting $30 million in new income just from redevelopments finishing this year.
But it's back-end weighted, right?
Yeah, very back-end weighted. Most of that cash doesn't show up until Q4. So you have to be patient. You're not going to see it next quarter.
And this is where he made that reference to the TV show Land Ban.
Yeah, talk about their properties in Midland, Texas. It was a great analogy. His point was, he doesn't care if it's a luxury mall in New Jersey or an oil town mall in Midland. His job is to make it the best it can be.
Squeezing every last drop of value out of the asset.
That's the game. Execution. He wants every property running at 100%.
So let's zoom out. Why should our listeners care about S2G right now? The stock's near its highs, the market's nervous.
Because it's a flight to quality. I mean, look at the last month. The big REIT ETF, VNQ, it's down. SPG's up almost 4%. Investors are fleeing the generic stuff and hiding in Simon.
Because of that fortress balance sheet.
And the 96% occupancy. When things get rough, the C malls die. The A malls, like Simon's, they actually gain market share.
And we have to just hammer this point on one more time. Ignore the GAAP EPS.
Please. Ignore the headlines. The real scoreboard is FFO. As long as that's ticking up, the business is working.
All right, that brings us to my favorite segment, the part of the deep dive where we pitch a trade that is plausible, outrageous, and to be very clear, is absolutely not financial advice.
Let's do it.
What's the trade?
I'm calling this one the Landman, luxury arb spread.
Okay, luxury arb. I'm intrigued.
So just think about what Simon told us. He said, we own the IP rights, we own the eviction rights, we own the redevelopment rights. He holds all the cards.
And he also told us the tenants are in trouble because of tariffs.
He basically telegraphed the whole play. So here's the trade. Leg 1. You go long STG, January 27 calls.
Okay, so you're betting on the stock to go up late next year when those redevelopments kick in.
Exactly. You're playing that back-end weighted pop. But you pair it with leg 2. You find a way to get short the physical inventory of the retailers inside the mall.
How do you do that? You can't short a sweater.
No, but you can build a synthetic short. You use derivatives on consumer discretionary ETFs, the ones that are heavy with department stores. You're essentially betting on their sales to fall off a cliff.
So walk me through the logic. You're long the landlord, but short the tenant.
You're betting that the tenants will fail because David Simon told you they're under pressure. But you believe SPG wins because the tenants fail.
So if Saks goes bankrupt.
If Saks goes bankrupt, your short position on the retailer pays off. And then Simon immediately seizes the real estate, invokes their REA rights, and turns that box into luxury condos. Your SPG calls explode higher.
You win if the tenant dies because Simon owns the funeral home and the graveyard.
It's structural arbitrage. You're betting on the dirt, not the shirt. The ultimate vulture developer play.
Bet on the dirt, not the shirt. That is dark. I love it. And again, for our compliance department, that is not financial advice. Please do not try that at home.
You will probably lose all your money. But it's a fun thought experiment.
It is. So to wrap this all up, SPG beats, FFO is solid, occupancy is high, the mall is dead.
Correct. The things to watch are that Taubman integration and the tariff fallout on the little guys. That's the risk.
David Simon is checking Polymarket on the call, so maybe we should be too. Check the numbers, trust the tape. We'll see you next quarter.
See you next time.